Hey guys, welcome back to the channel. So one of the things, we've been talking about is real estate, right? Well, one of the things we need to figure out is, if you're gonna buy a deal or, if you've already bought a deal, like how to calculate your return on investment, right? Because, your return on investment or your ROI is gonna be a measurement of how much money or profit is made on an investment as a percentage of its costs, right? And this metric's going to show us, how well your investment dollars are being used, right? And it's going to pay to know both what ROI is and how to calculate it, right? So you can use this to, figure out a deal. We're going to give an example later on, right? So return on investment is an accounting term that indicates the percentage of invested money that's recouped after deducting associated costs, right? For the non-accountant, that might sound kind of confusing, but let's say the formula is basically the investment gain minus investment cost divided by the cost, right? So, it's pretty easy to calculate, right? But, there's a number of variables that come into play, repair, maintenance cost, even the leverage, right? Leverage is going to be the amount of money borrowed with interest to make the initial investment, right? And these variables, they can affect your ROI numbers a little bit, right? So let's talk about some of the complications in calculating ROI, right? Well, when you buy property, the financing terms can greatly impact the overall cost of that investment, right? Complications in calculating ROI can occur when a property is refinanced or a second mortgage is taken out. Interest on a second loan or a refinance loan may increase, and loan fees may be charged, both of which can reduce the ROI. There may also be an increase in maintenance costs, or maybe an increase in property taxes, or even your, local utility rates, right? If the owner of a residential rental or commercial property pays these expenses, all these new numbers need to be plugged in to update your ROI. So, complex calculations may also be required for, property bought with an adjustable rate mortgage, right? Which is a loan with a rate that changes periodically throughout the duration of the loan. I want to look at the two primary methods to calculate ROI, right? So the first one we're going to talk about is going to be the cost method. And then the second one we're going to talk about is going to be the out-of-pocket method. And I'm going to try to give an example with each one. So hopefully, you can kind of maybe get a little bit better understanding, right? But let's start with the cost method, right? So the cost method is going to calculate ROI by dividing the equity in a property by that property's cost, right? So the example we're going to give here is, let's assume you bought a property for $100,000. After repairs and rehab, which costs an additional, let's say, $50,000, right? Then the property, you get it evaluated, right? And it gets valued at $200,000. So that's gonna make your equity position 50,000, right? So the way we get that is that it's now worth 200,000, right? And then we're gonna subtract, right, the 100,000 we bought it for, plus the 50,000 that we put into it. So 200,000 minus 150,000 gives us our equity of 50,000. So to use a cost method, divide the equity position by all the costs related to the purchase, repairs, rehab, and all that stuff, right? So now that we know all those numbers, right? The ROI in this instance, you're gonna take the $50,000 and divide it by the 150, right? You're gonna get 0.33, right? Then of course you multiply that by 100, so 33%. So in this case, we have a 33% return on investment. That's pretty good. All right, well, let's talk about the other one, the out-of-pocket method. Now, the out-of-pocket method is preferred by most real estate investors because, it's got higher ROA or ROI results, right? Using the numbers, we're gonna use the same numbers above. We're gonna assume the same properties bought for the same price, right? $100,000, but this time, the purchase was financed with a loan and a down payment of $20,000. So, the out-of-pocket expense, right, is only $20,000, right? Repairs are still going to cost the same, so it's $50,000 for the repairs and rehab, for a total out-of-pocket expense of $70,000, right? Then again, we get the property, reevaluated, right? And it's worth $200,000. So then that equity position is 130, right? Because it's 200 is what we valued it at, and we've put 70,000 of our own money into it, right? 200,000 minus 70, 130,000. So the ROI in this case is going to be that 130,000 in equity divided by 200,000, which is 0.65. Again, multiply that by 100 to get 65%. Right? This is going to be almost double, right, of the first example's ROI. Right? The difference, of course, is, it's the loan, right? Leverage as a means of increasing ROI. So you might be saying, well then, okay, why would I not do the second one? Well, let's talk about first, what is a good return, right, for real estate investors? Because what you might consider good, what I might consider good, and what someone else might consider good, they might be very different from each other, right? So good ROI on real estate varies by risk tolerance, right? The more risk you're willing to take, the higher ROI you'll expect. Conversely, risk-averse investors may happily settle for lower ROIs in exchange for more certainty, right? In general, however, to make real estate investing worthwhile, a lot of investors aim for returns that match or exceed the average returns on the S&P 500. So the historical average for the S&P 500 is about 10%. Of course, you don't have to buy physical property to invest in real estate, right? REITs, real estate investment trusts, they trade like stocks on an exchange. They can provide diversification without the need to own and manage any property, right? In general, REIT returns are more volatile than physical property, right? Because they're trading on an exchange, right? But in the US, the annual return of REITs is about 13%, right? Well, how about, trying to aim for better than 13%? I mean, I wouldn't say it's too difficult or too easy. It just depends on the market again, right? Well, thing that I want a lot of people to understand, though, is return on investment doesn't equal profit, right? Because, of course, before ROI can be realized in actual cash profits, the property's got to be sold. Often our property will not sell at its market value. A real estate deal may close below the initial asking price, which reduces the final ROI calculation for that property. Also, there are costs associated with selling a real estate property, such as funds expended for repairs, painting, landscaping. The cost of advertising the property should also be added in, along with appraisal costs, the commission to the real estate agent or broker, and both advertising and commission expenses may be negotiated with the service provider. Real estate developers with more than one property to advertise and sell are in a better position to negotiate favorable rates with media outlets and brokers. ROI on multiple sales, however, with varying costs for advertising, commission, and financing and construction, presents complex accounting issues that are best handled by a professional. All right, then what's the bottom line here? Well, calculating ROI on real estate, it can be simple, it can be complex. Really, it's depending on all the variables that we talked about, right? In a decent economy, thriving economy, investing in real estate, whether it's residential or commercial, it's proven to be very profitable. Even in a kind of recessionary economy, when prices fall and cash is scarce, a lot of bargains in real estate are available for investors with the money to invest. When the economy recovers, as it always does, many investors can reap a good, sizable profit, right? And make sure that as a side note, for income tax or capital gains tax purposes, real estate property owners are urged to get professional tax advice from a reliable source, right? Like, make sure you're talking to your CPA, go get that help, right? So I really hope you guys got some good information out of this and kind of understand what's going on with real estate and how investing in it works, right? If you enjoyed this video, go ahead and give it a thumbs up. If you're not subscribed to the channel, I would very much appreciate it if you did. Until I see you guys in the next video, y'all be safe.